You see a pile of cash and your brain does something automatic. It reads abundance, it reads winning. That instinct is almost always wrong, and understanding why it is wrong is the beginning of understanding how drug money actually works at every level of the ladder. Start at the bottom. Not because it is the most dramatic place, but because it is the most misread. Someone is working a corner, or a building, or a phone. The mechanics vary. The economics are more consistent than people assume. Take a generalized picture of street-level retail in a mid-size American city, not a specific city, not a specific operation, a composite that holds across enough documented cases to be useful. Daily gross revenue, somewhere in the range of $200 to $400 on an average day. That number sounds like something. It sounds like $70,000 to $140,000 a year before you think about it carefully. People stop thinking about it carefully right there. That is the mistake. Here's what sits between gross revenue and anything that resembles income. Inventory. Product is not free. It is fronted or purchased. The margin on street retail after paying up the chain typically runs thin, somewhere between 20 and 35 cents on every dollar depending on product type, location, and how much leverage the person above you has. If your gross is $300 and your margin is 25%, you are working with $75 before anything else touches it. That is not a salary. That is a starting point. Now, the inventory is not stable. It spoils in the sense that markets shift. A supply disruption, 3 links above you, changes what you have access to and at what price, often with no warning. Demand evaporates on specific days for reasons you cannot predict or control. Someone gets arrested 4 blocks away and foot traffic drops to 0 for a week because the customers are scared. You are still on the hook for what you were fronted. The inventory risk does not travel upward. It lands on you. Theft is real. Non-payment is real. Both happen regularly and both come out of your margin, not the suppliers. When a customer does not pay, you absorb that loss. When product disappears through your hands for any reason, you absorb that loss. The books, to the extent there are books, are unforgiving at the bottom. Then there are what you might call the real taxes. These are not metaphorical. They are structural costs that never appear in anyone's accounting of street profit margins, but consume a portion of every dollar and a disproportionate amount of every hour. Protection is the first one. Depending on geography and organization, operating on any given corner or territory involves some arrangement, formal or informal, with whoever controls that space. That arrangement has a cost. Sometimes it is cash, sometimes it is time, showing up when required, performing functions outside of retail. Sometimes it is both. The arrangement is not optional. Violence risk is a cost with a dollar equivalent even when no money changes hands. The decisions you make to manage that risk, where you stand, when you move, who you talk to, what you carry and what you don't, all of those consume time and cognitive load. Time has value. Cognitive load degrades decision quality. The paranoia that accumulates in this environment is not a personality trait. It is a rational response to a genuine threat model. It is also expensive in ways that are hard to measure and impossible to recover. Legal exposure at this level is high contact and fast moving. Street level distribution attracts street level policing. That means searches. It means frequent contact with law enforcement in a context where any single encounter can trigger a chain of escalating charges. A misdemeanor becomes a felony based on quantity. A first charge becomes a third charge based on geography, near a school, near a park, based on prior record. The escalation from minor to major is not a distant risk. It is the standard operating mechanism of how prosecution actually works at the bottom of the distribution chain. The people who face the most aggressive enforcement and carry the heaviest charges are structurally the people with the least power and the smallest margins. That is not an accident. That is the architecture. Cash handling creates its own specific category of friction. There are no receipts. There is no credit. Every transaction exists only in memory and in whatever informal record keeping happens to exist. This creates a constant liquidity problem. You cannot deposit the money. You cannot save it in any conventional way. You cannot use it to build anything that requires documentation of income. The cash is technically an asset and functionally a liability. It has to be spent in ways that do not attract attention, which means inefficiently. Consumer goods, cash-intensive purchases, things that depreciate immediately. The wealth, to the extent any is accumulating, does not compound. It sits in a mattress analog and slowly becomes less valuable in real terms while generating no return. The paranoia-driven decision-making that emerges from cash handling is significant. When you cannot verify balances, when you cannot trust the people around you with certainty, when you are operating without institutional safeguards of any kind, decisions become defensive rather than strategic. Money gets hidden in ways that make it hard to access. Trust calculus dominates every interaction. The mental overhead of operating in an environment with no legal recourse for any grievance is enormous and chronic. It is not the kind of thing that shows up when someone is counting a pile of bills and seeing profit. Here is what that picture adds up to. A street-level participant working consistent hours in a mid-sized market, after margin, inventory risk, protection costs, time expenditure on risk management, and the structural inefficiency of unbanked cash may be earning an effective hourly rate that sits below minimum wage. Multiple researchers who have studied this with actual data have landed near that conclusion. The pile of cash is real. The profit embedded in it is not. Now here is where the ladder logic begins. As you move up from retail, something changes. The street contact decreases. The margins improve on paper, the intermediaries multiply, and the failure modes get larger, faster, and more total. Less likely to happen on any given Tuesday. Far more catastrophic when they do. That is the trade the ladder offers, and it is worth understanding exactly what is being traded. So consider what the ladder actually looks like one tier up. The runner is not the corner. The broker is not the runner. The local manager is not the broker. Each layer exists for one structural reason that has nothing to do with efficiency and everything to do with insulation. The person above you needs distance from the transaction. You are that distance. You are the buffer between the product and the consequence. Your role is to absorb what the person above you cannot afford to absorb. That is the job description, whether anyone ever says it out loud or not. The margin improves as you move up. That part is real. A mid-tier broker moving meaningful volume might see 40 to 55 cents on the dollar instead of the 20 to 35 cents that defines retail. On a supply chain handling $30,000 in weekly product, that spread difference looks significant on paper. It is significant on paper. The problem is that the volume required to realize that spread introduces a different category of obligation. You are no longer absorbing small losses from individual transactions. You are fronting money or holding inventory at a scale where a single event does not set you back a day or a week. It sets you back months. The margin improved, the loss magnitude scaled with it. Those two things move together. Most people notice the first one. The logistics get heavier at every rung. More handoffs means more people who know something. More people who know something means more surface area for dispute, for error, for someone to make a decision under pressure that costs everyone downstream. Each intermediary in a distribution chain is a node where information exists and where loyalty is untested until the moment it is tested, which is always the worst possible moment. You are not managing a supply chain with contracts and arbitration clauses. You are managing it with reputation, coercion, and the memory of the last time something went wrong. That is a brittle system. It holds until it does not. The disputes that arise at this level are not resolved through any institutional mechanism. There is no invoice dispute process. There is no mediation. There are two options and only two. Absorb the loss or enforce the debt. Enforcing the debt means violence or the credible threat of it. And here is the thing about using violence as a governance mechanism. It works in the short term, and it compounds the problem in the long term. Every act of enforcement is an event. Events generate witnesses. Witnesses generate exposure. Exposure generates investigations that do not stay narrow. A debt collection that would be a civil filing in any legal economy becomes a felony conspiracy in this one. The cost of governance at this level is not just the time and risk of enforcement itself. It is every chain of consequence that enforcement sets in motion. Legal exposure does not decrease as you move up the ladder. It changes shape. It becomes longer, harder to see coming, and more total when it arrives. Inventory concentration is the structural fragility that no one at this level fully prices in until it is too late. At street retail, a loss event is painful and local. A runner losing a package is a bad week. A mid-tier operator losing a shipment is a different calculation entirely. One seizure, one robbery, one deal that goes sideways for any reason, and the inventory loss is not the only problem. There is a debt to whoever supplied that inventory. There is the expectation from whoever was waiting to receive it. There are now two directions from which pressure arrives simultaneously, and neither of them is patient. What looked like a larger margin on a Tuesday morning looks like a liability cascade by Friday. The months of work required to recover from a single loss event represent a return on risk that would be unacceptable in any environment where you had a choice about whether to accept it. Now, Think about the people operating inside this system who did not have meaningful alternatives when they entered it. The desperation that made the entry point attractive. The fast cash, the immediate income in an environment with no other visible income does not disappear at the mid-tier. It deepens. The commitment required increases. The ability to exit without consequence decreases. Loyalty is demanded but not reciprocated upward. When something goes wrong, accountability travels down. When profit is distributed, a larger share travels up. The people doing the most exposed work at the highest frequency are the ones who can least afford to absorb the consequences and are most likely to be positioned to absorb them anyway. Burnout is structural, not incidental. The people who get churned through mid-tier roles are not failing because they lacked discipline or intelligence. They are failing because the system is designed to extract labor and absorb consequence at the bottom and middle while concentrating returns at the top. The replacement rate for mid-tier operators is high. The people who move up often do so because someone directly above them was arrested, killed, or removed in some other way that created a vacancy. Promotion in this structure is often a disaster inherited rather than a reward earned. Complexity compounds faster than profit as the operation scales. Each new intermediary is a variable that has to be managed. Each new territory is a negotiation that has to be maintained. Each new relationship is a potential weak link under pressure. The cognitive and logistical overhead required to manage a mid-sized distribution operation does not scale linearly with volume. It scales exponentially with the number of people who have to be trusted and monitored simultaneously. And every one of those people has their own risk calculation, their own desperation, their own moment where cooperation with law enforcement becomes a rational choice. You cannot audit loyalty the way you audit accounts. You find out what it is worth at the moment it is tested. The picture that emerges is not a growth business. It is a fragility accumulation business. Each rung of the ladder adds margin while multiplying the number of ways the entire structure can collapse and the speed at which that collapse propagates when it starts. The higher the position, the more total the consequences when the system folds. And the system folds, not sometimes, structurally. The question was never if. It was always how many people were inside it when it did. At some point, the math changes its shape entirely. The problem stops being about moving product and starts being about moving money. And those are not the same problem. They are not even the same category of problem. One requires logistics. The other requires transformation. Cash that cannot be explained is not wealth. It is evidence waiting to be cataloged. At street level, the cash problem is manageable because the volume is modest. A few $100s a week does not require a system. It just requires a pocket. But scale that operation to a mid-tier broker moving $30,000 in weekly product, and suddenly there is a cash management problem that has no clean solution. The money exists. It is physically real. You can hold it and count it. What you cannot do is spend it, invest it, deposit it, or build anything durable with it without explaining where it came from. And the explanation does not exist. That is a trap. The revenue is real. The wealth is not. The distance between those two things is where operations collapse. Think about what it costs to close that distance. The process of converting unaccountable cash into usable assets always involves giving a portion of it away. The mechanism does not matter for this analysis. What matters is the math. Estimates on the cost of cleaning money at scale range from 15 to 50 cents on the dollar, depending on volume, relationship, and risk exposure of whoever is facilitating the conversion. That is not a transaction fee. That is an implicit negative interest rate applied to every dollar generated before a single dollar can be used. A mid-tier operation running $1.5 million in annual cash revenue might retain $900,000 after laundering costs. The margin that looks strong at the product level is being eroded at the money level simultaneously. Both cuts happen. Most people calculate the first one and treat the second one as a future problem. It becomes a present problem very quickly. The lifestyle decision is where legal exposure becomes visible in the most literal sense. A person with no documented income who begins acquiring property, vehicles, jewelry, and cash-intensive assets is not invisible. They are the opposite of invisible. Asset forfeiture law does not require conviction. It requires a connection between an asset and suspected criminal activity that meets a civil standard of proof, which is meaningfully lower than the criminal standard most people assume is the threshold. A vehicle purchased with drug proceeds can be seized. The house can follow. The jewelry has a dollar amount attached to it in the evidence log. Every visible upgrade is a filing in a case that may not have started yet but will. The lifestyle that signals success to the people around you is the same lifestyle that signals priority target to the investigators building the case. Visibility is not a reward at this level. It is a liability with an interest rate. The institutional world functions as a continuous choke point for anyone trying to move unaccountable cash into legitimate systems. Banks file suspicious activity reports on transactions and patterns that deviate from account norms. Landlords in commercial and residential markets increasingly require income documentation and financial history. Vendors who receive large cash payments have their own reporting obligations. Tax filings create a documented record of what you claim to earn, which becomes a comparison point when investigators are looking at what you demonstrably spent. Every touch point with a legitimate institution is a moment where the gap between documented income and actual financial behavior becomes visible to someone with the authority to act on it. There is no friction-free path through these systems. Every workaround introduces new exposure at a different point in the network. Inside criminal organizations operating at meaningful scale, the financial management problem creates its own internal pathology. Someone has to track the money. Someone has to reconcile what went out and what came back. That function exists in every organization that handles significant volume, and it is performed not with audited accounts and fiduciary obligation, but with memory, reputation, and fear. Internal theft is endemic at every level of these structures. The person handling cash is also the person most positioned to skim from it and the person who will be held accountable if the numbers are wrong, regardless of where the discrepancy actually originated. The auditing mechanism is coercion. The consequence for unexplained shortfall is violence or the threat of it. This creates a perverse incentive structure where people manipulate records not to steal more efficiently, but to survive the accounting process. Loyalty enforced by fear does not produce accurate books. It produces books that tell the person with power what they need to hear until the discrepancy becomes too large to hide. Then it produces a crisis. The legal consequences for anyone inside these structures who reaches a level where money is moving in volume are not linear with involvement. Conspiracy frameworks allow prosecutors to attach culpability to everyone with knowledge of and participation in a broader operation, regardless of which individual transaction they personally handled. Mandatory minimum sentencing tied to drug quantity and monetary value creates sentences that scale upward in ways that are not intuitive to people pricing their own risk from inside the operation. A mid-tier participant who believes their personal exposure is limited to the transactions they touched directly often discovers during prosecution that the entire financial architecture of the organization is being attributed across the conspiracy. The sentence they face reflects the operation's total volume, not just their slice of it. That is not a technicality. That is how the statute was designed to function. And here is where the structure arrives at its central paradox. The better the operation performs, the larger the problem becomes. Growth in revenue is growth in unaccountable cash. Growth in unaccountable cash is growth in laundering costs and laundering risk. Growth in scale is growth in the number of people who know something. Growth in the number of people who know something is growth in the probability that one of them, under enough pressure, makes a calculation that ends the entire structure from the inside. Success does not solve the problems that define this system. It amplifies them. Each level of performance demands a deeper entanglement with institutions and systems, specifically designed to detect exactly the patterns that scale creates. The operation that works well enough, long enough, and large enough to feel like it succeeded has simply grown into a configuration that is harder to miss, harder to unwind, and more total in its consequences when it finally comes apart. The money was never the destination. It was always the evidence. At the top of the structure, the numbers become almost abstract. An organization operating at cartel scale is not moving hundreds of thousands of dollars. It is moving billions. The Sinaloa cartel has been estimated to generate somewhere between $3 billion and $19 billion annually, depending on the methodology and who is doing the estimating. Those numbers are cited in congressional hearings and academic papers, and then repeated as though they represent something solid. They do not. They represent gross revenue in a system with costs that would destroy any conventional business model before the first quarterly report. Consider what the operating budget actually looks like at this scale. Logistics infrastructure across multiple countries, warehousing, transport networks, airstrips, tunnels that cost millions each to construct and can be rendered worthless by a single interdiction event. Bribery is not an incidental cost at this level. It is a line item, a documented budget. Payments to customs officials, law enforcement, military personnel, and political figures are not aberrations. They are the supply chain. Estimates from enforcement agencies suggest cartel organizations spend hundreds of millions annually on corruption payments across the jurisdictions they operate in. That is not a metaphor for systemic rot. That is a payroll. Someone tracks it, someone distributes it, someone is responsible when a payment goes missing or a contact goes silent. Enforcement is its own cost center. The people whose function is to maintain internal compliance and territorial control receive compensation, weapons, vehicles, and communication infrastructure. They generate liability. When they operate, they create evidence. When they fail, the organization absorbs the operational loss and the investigative attention simultaneously. A cartel is not a criminal conspiracy with a business attached. It is a paramilitary organization with a revenue model, and the paramilitary costs are not separable from the financial architecture. Then there is political risk, not in the way a multinational corporation models political risk, with scenario planning and insurance instruments. Political risk at cartel scale means that a change in government can restructure every arrangement built over years of cultivated relationships. It means that an enforcement priority shift in Washington or Mexico City or Bogota can redirect resources toward exactly the nodes that previously operated without friction. It means that the trust and access purchased at significant cost can be voided overnight by an election, an extradition request, or a rival organization willing to pay more for the same official's cooperation. Supply chain fragility at this scale is not a theoretical vulnerability, it is a recurring operational reality. A single interdiction event, a tunnel sealed, a shipment seized, a network of couriers rolled up in coordinated arrest, does not merely reduce revenue, it creates a cascade. The organization absorbs the loss, it attempts to identify the leak. The process of identifying the leak is violent, paranoid, and frequently inaccurate. People who had nothing to do with the interdiction are killed because the investigation process functions through fear rather than evidence. The supply disruption triggers debt pressure at every level below it. Distributors who fronted payment expect delivery or reimbursement. That expectation is enforced by the same mechanisms that enforce every other obligation in the network. A choke point in the supply chain is not a financial inconvenience. It is the beginning of a sequence of violence. And this is the structural truth that gross revenue numbers never communicate. The income is real. The stability is not. Huge annual figures sit on top of tail risks that would not be acceptable in any legitimate financial context. A single cooperative witness can unravel years of careful construction. A faction dispute over succession or territory converts internal loyalty structures into active threats. An asset seizure of sufficient scale removes the capital required to maintain the bribery infrastructure, which means the protection disappears, which means the exposure accelerates. These are not edge cases. They are the recurring pattern across the documented history of every major trafficking organization. The revenues are large. The collapses are total. Organizations fracture in predictable ways. A leader is arrested or killed. The succession is not clean because succession was never formalized. Competing claims emerge. The enforcement apparatus that previously pointed outward now points inward. Informants, and there are always informants at some level of the structure, become more valuable to investigators during periods of internal conflict because the people with information become more willing to use it as protection. Corruption that held the network together begins to fray as payments become inconsistent and officials calculate their own risk exposure differently in a destabilized environment. Trust, which was never built on anything more durable than mutual interest and mutual fear, decays under sustained pressure until the structure it was holding together can no longer hold. The communities that exist within or adjacent to these operations absorb costs that never appear in any financial accounting. Intimidation is a tool of market control, and its targets are people. Displacement follows when territory is contested. Recruitment pressure falls on young people in economically marginal areas because the organization requires continuous replacement of personnel lost to arrest, violence, and attrition. Violence is not a side effect of cartel economics. It is a function of cartel economics deployed deliberately to suppress competition, enforce compliance, and maintain territorial control. The communities that live inside that geography do not experience it as a financial externality. They experience it as the condition of their lives. The cost that never appears on the ledger is carried entirely by them. The endgames are not varied. They are a short list and they narrow as you move up the structure. Arrest, extradition to a jurisdiction where the sentence is measured in decades and the isolation is total. Betrayal by someone who was close enough to know everything and desperate enough or pragmatic enough to trade it. Asset seizure that strips the accumulated wealth down to what can be hidden and what cannot be found, which is always less than what was accumulated. Exile in a country that provides geographic distance but not safety and not peace. Or death, which comes from rivals, from internal disputes, from the enforcement operations that targeted the organization for years and finally found the right moment. The ladder that looked like ascent from the bottom is a narrowing corridor at the top. The people who built the most durable criminal empires in documented history mostly ended in one of those 5 places. The variation is in the sequence, not the destination. Here's what the entire structure, from the street corner to the cartel boardroom, actually demonstrates. Gross revenue is not wealth. Scale is not safety. Complexity is not protection. Every level of this system operates with catastrophic downside risk that is obscured by the visible cash, the lifestyle, and the social architecture of loyalty and fear that surrounds it. The apparent profit is real. The fragility underneath it is more real. And the wreckage, financial, physical, and human, is distributed across people who mostly never saw much of the money to begin with. If this series made you want to understand how money actually builds over time, look into fee-only financial planning, index fund investing, and the basics of legal personal finance. There are resources that cost nothing and carry no downside risk. And if this conversation about drug policy and harm made you want to engage with the evidence, look for organizations working on evidence-based harm reduction. The systems that actually help people are not dramatic. They are methodical, they compound. That is the only thing that was ever worth building.